Welcome back. This update is for April 20th, 2026. Due to high demand this week, we are diving deep into the Nifty 50, the heart of the Indian stock market. Is the recent all-time high just a temporary peak, or are we looking at a major 54-month cycle crest? Today, we use Hurst cycle analysis to find the potential 20,327 downside target and map out the road ahead for the rest of the year. Let's get started. Before we dive into the cycles, please take a moment to review the financial disclaimer on your screen. This analysis is for educational purposes only. Let's start by the long-term cycle, the 18-month. On April 2025, the Nifty 50 formed a major low, at least an 18-month cycle low, perhaps a longer cycle low, the 54-month, but let's focus only on the 18-month cycle. Between the April 2025 low and last month low, 11 months elapsed. 11-month is way too short for an 18-month cycle low, so we can expect this low to occur between September and October. After forming a 26,393 all-time high on January this year, the Nifty 50 crossed below his cycle line at 23,350. The crossing below his 18-month cycle line, or FLD, give two very important information. The first one, the crossing confirmed the previous high before the crossing is at least the 18-month cycle. The second information is that we have a 20,327 potential downside target. By forming his peak in January, the Nifty 50 formed his peak right at the crest of the cycle. Perfect timing. Also, last month, the Nifty 50 crossed below his cycle trend line, or VTL, another very important information. Indeed, according to the Hurst rules, when prices cross below his VTL, this confirm a peak of the next longer cycle form a peak, in this case the 54-month peak. To label officially the January peak as 54-month cycle peak, the Nifty 50 have to keep trading below his VTL, the 40-week cycle. By placing the first 40-week cycle low since the April 2025 low at the end of January, the 40-week is 42-week long, only 3 weeks longer than the 38.97-week average from the Hurst nominal model. There is another possible scenario is by placing the 40-week low in March. This 40-week will be 51-week long. 51-week is very long, is 11 weeks longer than the nominal model, but is not impossible. And due to the size of the correction following the all-time high, this scenario is really possible. We have to keep in mind the possibility of this scenario. What next for the 40-week cycle? If the second 40-week cycle have the same length than the first one, we can expect the Nifty 50 to form as low during the third week of November. If the market matched the Hurst nominal model, then we can expect a low for the first week of November. The time zone is during the first 3 weeks of November, the blue zone. If we place the last 40-week cycle low in March, we can expect the next low to form by the end of December. How can we solve the problem? We should be able to resolve this problem by analyzing the shorter cycles, especially the 80-day cycle. During the first week of March, the Nifty 50 crossed below his cycle line at 25,030, providing a 23,687 potential downside target. The week after the market met his target. This was the first trading signal of the year. With one successful signal out of one, the 40-week cycle have a success rate of 100%. If you find this cycle synchronization helpful, make sure to visit tradingmarketcycles.com for the full technical charts. The 20-week cycle. Due to the Hurst rule of synchronicity, the last 20-week cycle formed at the same time than the 40-week at the end of January or in March. Since for now we are uncertain to where to place the 40-week low, we have the same issue with this 20-week cycle, since he is synchronized with the 40-week. Every 6 cycles, I process a new spectral analysis to update the cycle length. For the 20-week, the length is now 19.6 week, which is still very close to the 19.48 average from the Hurst nominal model. Adding this average to the January low, the next time target for this 20-week is the second week of June. The peak for this 20-week cycle should form about now. During the third week of January, the Nifty 50 crossed below his cycle line at 25,911 for a 25,449. The target has been met 1 week later. With one successful trading signal, the 20-week cycle have 100% of success rate. Technically, at the stage of the cycle, the Nifty 50 should cross above his cycle line, providing an upside target. This will be a crucial information to know how much bullishness left in the market. On trading point of view, knowing where exactly to place the 40 and 20-week cycle is not very important, since the weekly cycles are used more for the longer trend direction than trading the market. Let's see now the 80-day cycle. Let's see if by analyzing the 80-day cycle we can solve the weekly cycles problem. The beauty of the Hurst cycle is at one point the shorter cycles identify the longer cycles. Due to the very important Hurst rule of synchronicity, cycles are like a puzzle, everything have to fit together. In balanced market, after forming a 40-week cycle, the market should cross above his 80-day cycle line, confirming the trough is the 80-day, 20-week, and 40-week trough. After reaching his target, the market should form his first 80-day low on his cycle line. We know with certainty the March low is an 80-day low. Indeed, from the January low to March low, 60 days have passed. 68 days is the average length for the 80-day cycle on the Hurst nominal model. With a very high degree of confidence, we can label the March 30th is the 80-day trough. The January low is also an 80-day low. Like I mentioned above, after the 80-day low formation, the market should cross above his cycle line. After the January low, the Nifty 50 found resistance on his cycle line and resume his decline. From there is two different possibilities. The first one is if the January low is the 40-week low, and since the market didn't cross above his cycle line, this is a very bearish signal. Then in this scenario, we can expect the actual rally end at his cycle line, then resume his decline. In the second option, if the March 30th low is the 40-week low, then the Nifty 50 should cross above his cycle line, provide an upside target, then form his next 80-day low on his cycle line on June 6th, with a peak around May 3rd. On June 6th, the Nifty 50 cycle line, or FLD, will be around 23,800, the 40-day cycle. The last 40-day cycle was on March 30. If we add the Hurst average length nominal model for the 40-day cycle 34.1 day to the March low, May 3rd will be the potential date for the next 40-day low formation. The peak should occur about now. If the peak occur on the right part of the cycle, Hurst call that right time translation. This will be a bullish sign, and we can expect a moderate correction for the next 40-day low formation. Technically in balance market, the Nifty 50 should form his next 40-day low on his cycle line, which will be around 22,770. Last week on Wednesday 15, the market crossed above his cycle line at 23,800, providing a 25,145 potential upside target. Since the beginning of the year, the 40-day cycle provides 4 trading signals, with 3 positive out of 4. The success rate for the 40-day cycle is 75%. As we have seen, the Nifty 50 is at a critical crossroads between bearish cycle confirmations and short-term recovery targets. To stay ahead of these moves, make sure to hit the like button and subscribe for our weekly updates. For more frequent, shorter cycle analysis, head over to my website, tradingmarketcycles.com. I also have a dedicated short-term trading corner on the site where I break down these shorter movements in even more detail. See you in the next analysis.